Hello and welcome to the Deep Dive by CAP STRAT. In this series, we're taking a particular area of the economy or market and exploring it in much more detail. And we decided for the first edition of the Deep Dive, we'll be looking at the labor market. So Mike, where should we start? What should we look at from a labor market perspective?
We're looking at job openings per unemployed person. So this ratio, when it's high, it suggests the labor market is very tight or hot. And when it's low, it suggests the labor market is very loose or cool. So where the economy was in March 2022, we reached a new all-time high in this ratio, 2 job openings per unemployed person in the economy. And what's subsequently happened over the last 2 years has been that ratio has fallen to 1.2, so a substantial loosening of the labor market, a rebalancing, if you will, back to pre-pandemic levels. And how this typically happens, it typically is not very benign.
Right.
Typically, the way to rebalance the labor market this quickly, this significantly, is by substantially increasing the number of unemployed persons and getting companies to take down job openings.
Right.
And that happens during recessions. So you'll see all these prior peaks, they're followed by a red shaded area. But instead what we've had is a very benign rebalancing. So over this 2-year time period, the unemployment rate has been 4% or less. Non-farm payrolls on a monthly basis have averaged 290,000 jobs added per month.
Yep.
And there's been no recession. So something different has definitely happened this time around.
Yeah, so how is that even possible that we're seeing such a big adjustment in the labor market without hearing about these recession fears or slowing economic growth? What's different this time?
In an open economy where you have lots of job opportunities, very high and rising wages to attract labor, a strong US dollar, and geopolitical risk and uncertainty and chaos elsewhere in the world, what you get is, in the US, an immigration boom. And so in 2023, it's now estimated that 3.3 million immigrants entered the country. The CBO, prior to January of this year, we're estimating last year it was about 1 million. So a huge upside surprise in terms of immigration. And you think about the impact and the implications of that. When immigrants come into the country, they are more likely than natural citizens to participate in the labor market. Mm-hmm. Usually they're here to work. Their labor is supplied in lower wage areas of the economy, which in this instance was great because some of the tightest areas of the labor market were in industries that needed low wage labor. So it did a tremendous amount of rebalancing there. And also they generally contribute more to supply than they do to demand. Said differently, they have higher than average savings rates and they're pretty likely to send remittances home with them. So you take all that net, what you get is an unexpected additional 2.3 million people coming into the country. A lot of them are going to end up staying, are likely stayers, supplying their labor, supplying less in terms of demand. Yeah. That's great if you're trying to defeat inflation. It's a gift to the Fed if you're trying to defeat inflation.
Yeah, absolutely. And I think, one thing that's always important to note when we're talking immigration, especially this green cohort here, the other non-immigrants, is, by its very nature, it's difficult to get accurate, timely data on the immigration front. So when we're looking at the labor market, where can we see the impacts of this immigration and where should we know to look to where this impact isn't being taken into account?
Yeah, so if we look at the 2 most watched measures of labor market health, you start with the establishment survey, the non-farm payrolls report. That's the one we get every month. It's the big ticket economic item where you obviously survey businesses or establishments. And then there's the household survey where you survey households. One of them captures most of the immigration boom. The other captures none of it. And so you're seeing a huge divergence in terms of the stories they're telling about the health of the labor market. In the establishment survey, if you survey a business, they can report payrolls regardless of employees' legal status. So it's estimated that the non-farm payrolls report is capturing anywhere from 60% to 90% of the immigration boom and that impact on employment in the country. And that's humming along. You're looking at 255,000 jobs added over the past 6 months in the non-farm payrolls report. The household survey, however, when the BLS does the household survey, you can't call a household that they don't know exists. And so it's capturing virtually none of the immigration boom, and it tells something completely different. It's saying starting back half of last year, the labor market slowed sharply. We're now, over the past 6 months, losing an average of 169,000 jobs per month.
Yeah.
So one is saying everything's okay, one is saying we're in a recession. And just based on the divergences and how they account for the immigration boom.
And so this situation automatically begs the question, right? Which one's right? Or in the case of these data points that are continually revised, are these just going to get revised closer together and this becomes a non-issue by itself?
So not quite. The household survey is going to get revised up. As the census gets adjusted, these likely stayers fall into the population estimate. Those numbers will likely come up. It's tough to say how much, but they'll come up. The establishment survey, even though it's capturing most but not all of the likely impact from immigration, you would think it would get revised up, but the next revisions, in our view, are most likely going to be revised down. So these things are going to come closer together that way. And the reason why we think that is the next benchmark revision for the establishment survey is by looking at state unemployment insurance claims data. And generally speaking, that is far less likely to include immigrants with temporary, pending, or non-legal status than just surveying businesses. So from that estimate, or from that standpoint, it'll probably take into account less of the immigration boom when the next revisions happen.
Yeah.
But then the other thing is the net birth death model, which we should just go right to. That's a significant source of revisions for the establishment survey. So I'll just keep going on that then. So
tell us more.
So basically what happens is, if you're the BLS and you're doing the establishment survey, you don't capture businesses being formed or businesses being shut down in real time. You capture them with a lag through the revision process. And so what they do is they try to estimate how many jobs were added based on an estimate of how many businesses were formed during the month. It's called the net birth death model. And what you can see is it's usually pretty conservative, but it's usually very wrong around significant economic turning points. If you look here, the light blue line is the BLS's initial estimate of jobs added due to net business birth deaths. And then the dark blue line is what that number was ultimately revised to.
Right.
And if you look at 2008, 2009, that was a substantial downward revision. Basically, the estimate was revised down by about 400,000 jobs in 2009. And the reasons all make sense because we were going through a nasty recession. Businesses were getting shut all over the place, and that wasn't captured in the model to start out. But you look at where we're at now, over the past 12 months, the net birth death model has been responsible for 1.5 million of the total 2.5 million jobs added over the past year, according to the establishment survey. That's a huge contribution. 60% of the total jobs estimated to have been added over the past 12 months are coming from this model that's usually very wrong around economic turning points. So we're always second guessing that number, particularly now because it's elevated as a share of the total jobs added.
Right.
So we have to look at business formations, business closures in other ways.
Yeah,
right.
Yeah, exactly. Elevated relative to the number of jobs being produced, elevated recently compared to its recent historical model assumptions. The question becomes, is this an appropriate assumption, and how can we start to get another layer deeper in terms of evaluating how appropriate this assumption is?
Sometimes it's appropriate. Right now, we'll take the under on that 1.5 million. We think it'll get revised down because if you look at based on business application documents captured by the census, the U.S. Census, and the average number of businesses that actually make it a year. A lot of them don't
Right.
make it past a year. The Census Bureau estimates that year-over-year growth in business formations will be flat.
About flat.
So
Yep.
almost no new business births. This makes sense. It's expensive to start a business right now. Companies outside of the Magnificent Seven have been going through an earnings recession for quite some time. Labor's expensive still. So that seems to make sense. And then on the other side of the net birth death is the death. You can track business bankruptcy filings almost in real time from federal court data. Those 12-month sum year-over-year change are up about 40%. So this is looking like more deaths than births, and that would go for us to say that net birth death estimate of 1.5 million jobs added over the past 12 months, that will probably get revised down.
Pretty aggressive. Yeah.
Yep.
And so what we always want to do internally is take these ideas and these data points and put them through the economic and investment framework.
Mm-hmm.
So let's go ahead and do that for the labor market, talking through framework implications. You talked a little bit about inflation earlier. Maybe that's the best place to start here. Overall impact to inflation from these labor market dynamics.
Downward pressure on core inflation. If the immigration boom continues, then you're going to continue to have people come into the country that supply more in terms of labor than they demand in terms of goods and services. And so that should put downward pressure on inflation. This will be a big ticket item around the presidential election. So if that changes dramatically and immigration falls off a cliff over the next 2 years or so, then we'd have to revisit this. Stay tuned for your future deep dive where we talk about the implications of the election. But you think that would be putting downward pressure on inflation. Then you move to liquidity. So what's the Fed going to do with that? Well, coming into 2023, the Fed thought the sustainable level of employment growth, which is how many jobs can you add to the economy per month without running the risk of increasing inflation, was like 130,000 jobs.
Right.
If you factor in an additional 2.3 million immigrants, more than you expected, what it does is it takes that level and it increases it to over 200,000, like 230,000 per month. So what that means for the Fed is they've now all of a sudden become very comfortable with the strong non-farm payrolls gain in terms of, hey, this is not going to necessarily create a wage price spiral dynamic that I'm afraid of. So in our view, that takes rate hikes off the table. Absolutely.
Certainly. Yeah.
Then if the Fed looks at the net business birth deaths and the actual data that we just looked at and the household survey, they should conclude that the labor market absent immigration is very weak because monetary policy is very restrictive and it's working as it should be working.
Yeah.
And therefore, our view is we've revised our forecast to be 2 cuts this year, 1 in September, 1 in December in terms of interest rate cuts. And we think that's biased downwards, meaning if the labor market data breaks down more quickly, they will cut faster.
Right.
All that is net a positive for liquidity. So this is a pretty good starting point.
You like that?
Inflation is the
If you're a Fed
boogeyman.
member.
Right. Inflation is the boogeyman for all financial assets. That should be coming down with liquidity coming up. Every financial asset loves liquidity. And then what's the impact on economic growth and recession? You know, there are positives and negatives here. If you have that many people coming into the country, it's pretty good for economic growth. They're participating in the economy for as long as they stay. But at the same time, this is still a very difficult environment to start a business.
Yeah.
And so we think that speaks to economic growth slowing in 2024 to a more sustainable but still acceptable level.
Right.
Which brings in recession risk.
Yep.
Right now, I mean, our recession signal is not active. What we're looking for is what we're tracking is we want to see if there's a more rapid deterioration in the labor market. We would see that through jobless claims figures. Right now, initial jobless claims, they've ticked up here recently, but they're only about halfway to the key trigger threshold for a recession. So we're not yet seeing the type of layoffs that are consistent with a recession. So that's good news. Net, this isn't bad.
Not bad at all.
This isn't bad. Very different if you speak to it from a political perspective, but through the investment framework, it's not bad.
Yeah, we'll keep a healthy arm's length distance from the political conversations here, but that will do it for the first edition of the Deep Dive. If you have any questions or comments, please feel free to reach out.